Okay, so let's continue. Why are countries racing to the bottom? So let's come back to the phenomenon, the problem of profit shifting. Remember in our example, if our multinational could shift its US-made profits to Ireland, it would pay 3 billion instead of 30 billion in tax. Well, let's take that scenario from Ireland's perspective. If the Irish government can induce this multinational A to shift its profits to Ireland, it gains 3 billions. It's like money for nothing in some sense, so at least as when we look at it this way. Lowering the effective corporate tax rates may therefore increase tax revenues for these tax haven countries. How can this be? Well, keep in mind that the corporate tax revenue that Ireland or any other country collects is some function of the tax rate it applies to its tax base. Now, if the tax rate goes down, you would expect corporate tax revenue to decrease, but if the tax rate goes down such that it actually increases the amounts of the tax base, and if this increase in the tax base, the taxable income, is greater than the decrease in the tax rate, then we should see some overall increase in corporate tax revenues. And indeed, some tax havens successfully manage to boost the tax base to a greater extent than the falling tax rate, as we shall see. Here is a graph from a great paper. It's the recommended reading for this list, not the required. The recommended reading for this week, not the required one. The missing profits of nations. And essentially what they are doing in this paper is trying to estimate how much each country gains or loses through massive multinationals shifting their profits. We see in red here the countries they define as tax havens, and blue, well, non-havens. Malta, Luxembourg, Cyprus, Hong Kong, Ireland seem to have a greater amount of corporate income tax revenue as a percentage of their gross national income than non-havens. There are some exceptions to this, Puerto Rico and the Netherlands, but by and large, most of the havens, tax havens, seem to be increasing their the part of their tax revenue which is actually from corporations relative to all those other countries, despite having a low corporate tax rate. Let's get a bit more particular. Here we have the example of Ireland. Here on the left-hand side, we have the tax revenue, again as a percentage of gross national income from corporate income. So tax revenue from corporate income. And on the right-hand side, we have the nominal tax rate. As I said in the first part, there is, since 2003, the corporate tax rate in the nominal terms has been at 12.5%. So what we see is what perhaps we wouldn't expect in a world without profit shifting and multinational enterprises, namely that the tax rate has fallen and the tax revenue from corporations has at the same time increased. So this is a pretty good indication that tax havens are actually gaining in tax revenue from their attempts to lure in these massive multinationals. Okay, so that kind of explains what tax havens are getting out of this. But is it everything? Well, here comes the notion of tax competition, so distinct from profit shifting. Tax competition, for our purpose, we'll define as the phenomenon where countries gain in the form of real capital inflows, so investments, and higher employment when multinationals decide to locate production where the effective corporate tax rate is low or lowest. So imagine Ireland has a really low effective corporate tax rate. Multinationals don't just shift their profits there, they actually locate some of their production there in order to avail of these low corporate tax rates, which therefore benefits Ireland to an extent greater than just increased tax revenue. For Ireland, we can see this in various ways. I think the easiest way to see it is in the employment rate, because there's no real way of misinterpreting this as there is with other macroeconomic variables. So, for example, in the rate of employment in manufacturing due exclusively to foreign affiliates in Ireland was 32% in 1983, and it has risen up until 78% in 2017. If we look at the overall employment rate due to US-owned foreign affiliates in particular, it has risen, it has doubled basically in that same time period. Overall employment rates due to all foreign affiliates, not just US-owned foreign affiliates, unfortunately there's not as much data, but it's quite high. Around 16 or 15% of all people employed in Ireland are actually employed and working for corporations owned by people outside of Ireland. Let's go into a little more detail on how much capital is shifted to tax havens and how many jobs are created in tax havens or shifted to tax havens compared to the amount of profits shifted to tax havens. Here we have a graph from Sayers and Zuckman, the same book from last week's lecture. What we see first and foremost is that the amount of profits as a fraction of all profits of multinationals around the world, the amount of profits booked in tax havens as a percentage has increased dramatically since the 1960s. So it's gone from around 5% to around 60% of all multinational profits are now booked in tax havens. This is a clear indication of profit shifting. But let's have a look at real tangible capital, not just paper profits. Capital has also increased in tax havens. Again, maybe 6 or 7% in 1965, up to nearly 20% in 2020, or in 2019, I think. So there's an increase, which therefore definitely does benefit tax havens like Bermuda, Ireland, Netherlands, Singapore, and so on. But the phenomenon is not as great as the profit shifting phenomenon. So tax competition seems to be quite relevant, but not as prevalent as profit shifting. Wages paid to employees in tax havens. So this is in some sense a measure of the job boost. So this is the wage bill as a total. That has increased from around 5% to around 10%. Again, there's an increase, but not as great as the profit shifting phenomenon. But at the same time, while this fraction is small, only 10% of all jobs, you could say, are in tax havens. 10% of all worldwide multinational jobs, in some sense, are in tax havens. That's still a massive or a big deal to this small economy. So 10% of a massive number is especially important to a small country like Ireland or Bermuda and so on. And the second thing to take into consideration, well, these fractions are increasing. So it seems that if you are a tax haven, there are some real tangible benefits to remaining as a tax haven. But at the same time, can you expect other countries who copy the tax haven model to benefit? Well, that's a different question. It's very hard to know if such countries would actually benefit at all. So that leads to the question. I mean, if there are some benefits to being a tax haven, perhaps racing to the bottom can boost demand and growth. Well, no. And this is based on the paper I've already mentioned that's going to be coming out in the months to come. There are two main conditions, it seems. Firstly, economies must be sufficiently small in order to be able to boost investments from lowering their corporate tax rates. And this means that massive major economies, US, Japan, Germany, etc., seem to be extremely unlikely to gain by boosting demand through lowering their corporate tax rates. Because effectively they would be receiving less tax revenues from their domestic corporations just by trying to attract a few multinationals within their borders. And this could be seen as a reason why the G7, the group of 7 economies, are cutting their tax rates more slowly. They're still engaged in this race to the bottom, but not with the same sorts of efforts as those tax havens and other countries around the world. The second condition is that economies must cut their tax rates, corporate tax rates, to a sufficient extent. It's not enough to just be a little bit lower than other countries out there. You must be much lower than other countries out there. But at the same time, as we've seen, current tax havens have rates near zero already. Undercutting them is virtually impossible. And even if it were not, even if you're able to, undercut a tax haven like Ireland, who's that is at around 3%, and get to a tax rate at around 0%, could multinationals trust that your new country that is now trying to offer a super low, virtually zero effective corporate tax rate, and trust that it's going to stay so low and stay at zero? Well, perhaps not. Perhaps it will just stick to the current tax rates, the current tax havens that these multinationals trust and have a reputation of being, well, corporation friendly, because they have been so sort of friendly to these multinationals for decades. So it doesn't seem likely that even small economies can take up the role that these tax havens like Ireland and so on already have. So in that sense, this is hence the title. It seems that there's this phenomenon where you've got the madmen leading the blind. Yeah, you've got the countries that were sort of mad enough to go to the bottom in corporate tax first, who benefited, leading the countries that seem to just be following their example and hoping to benefit like these tax havens, despite there being very little reason that they would. So again, we asked the question, why are countries racing to the bottom? Well, we've seen that tax havens at the bottom benefits, but why are these madmen, the blind larger economies following? Well, we can offer a few speculative reasons on this. Perhaps the governments in these larger economies hope that reducing their corporate tax rates will reduce the incentive to shift profits to those tax havens. This is often seen in some of the rhetoric that politicians come out with, and even fellow economists put forward. But at the same time, even as the likes of the United States and the United Kingdom and so on have reduced their corporate tax rates, the phenomenon of profit shifting has only increased. So there's hope that it will reduce the incentive to shift profits if the tax gap between countries is smaller. This doesn't seem to be playing out. It could be that these governments are lowering corporate tax rates in the hope that it will create jobs and real investments, that the cost of capital is cheaper and therefore corporations will invest more. But there is very little evidence to back up this sort of poor economic theory. Perhaps these governments just simply fail to understand that effective corporate tax rates can't be much further undercut. It's very hard to take up the role of tax haven now because it's already been well established and there seems to be some sort of first mover advantage. In that case, we've kind of got these benevolent governments that are trying to boost demand and growth, but they just don't fully understand the complexity of the situation. Lastly, perhaps they're simply subject to regulatory capture. So not so benevolent, but simply acting in the interest of the stakeholders in society. That's corporation tax. Lower corporation tax benefits most. So it's still quite an open question, but we can at least put forward some reasons to why the countries are still racing to the bottom. Okay, lastly, in this part at least, why should we care about this race to the bottom in corporate tax rates? Well, firstly, as we said earlier, it concerns inequality massively. A second main concern is, well, corporate tax, so profit shifting is essentially a zero-sum game. Tax havens attract or steal the tax revenues of larger economies. So it's not that they're creating new tax revenues. There is a loss associated with the gain. There's also just the pure wastefulness of all this tax planning. For example, General Electric employs around 1,000 tax lawyers just to work out how to reduce their tax liability. This has no greater benefit for the economy or for social welfare as a whole. And at the same time, then, the tax authorities require more funding and more time to monitor these increasingly complex schemes and means of getting around these laws. Lastly, we have what Palan calls the commercialization of state sovereignty. This is the idea that, well, implicitly, these private-owned corporations are determining or strongly influencing how public bodies, democratic bodies, act. And this may not be in the interest of political institutions. Okay, so there are many reasons to care about this. It seems to be worsening inequality and to little positive effect. So therefore, what can we do in order to address this? Well, the first thing to take into consideration is the finding that, well, the larger the economy, the less likely a tax cut is going to increase employment, investment, or tax revenue. So we can say already that if you're considering an economy like Germany, the US, and so on, it's extremely hard to justify any further corporate tax cuts because it just doesn't seem to be, in the long run, boosting any macroeconomic variables that we care about, like employment and demand and so on. But let's go further and let's try to sort of address the bigger phenomenon as a whole. Here I'm going to pick up on Sayers and Zuckman's proposal because I think it's quite useful and it seems to address the root problems. There are 4 pillars according to their proposal. First is exemplarity, coordination is second, third defense measures, and then fourth sanctions against free riders. So that's the last thing we'll speak about today. What do all of these pillars mean? Well, exemplarity means that each country must police its own multinationals. That's the principle. To consider this, first take into account that the German corporate tax rate is currently 30%. Now let's imagine a German corporation like Siemens pays only 5% tax in Singapore. Well then, Germany should assert its right to tax the missing 25% when the profits move back to Germany. Or for example, if another German corporation like Bosch pays 3% tax in Luxembourg, then Germany should impose a further 27% tax upon repatriation. In that case, Germany is in some sense trying to always fill in the tax gap or the tax deficits to reduce the incentive for these corporations to shop around different countries in some sense. So generally, of course, we have these specific examples here, but generally the idea is to impose what is called a remedial tax, so a sort of remedy tax on all multinational enterprises, which is simply the difference between the domestic tax rate and the tax rate that is paid in this foreign country. What are the benefits of this proposal? Well, firstly, it does not require international action or agreements, and it doesn't violate any existing treaties. Secondly, large companies are already compelled to provide data on taxes paid around the world. This is part of the OECD base erosion and profit shifting initiative. So this is, in some sense, a sort of hint of hope, considering this otherwise troublesome or problematic development, is that the OECD has come together, hasn't really done enough, but they have put in place many measures like collecting information on where corporations are paying taxes, which can be really used for effective, more radical policy to try and address the problem. So that's the first principle. The idea that each country must police its own multinationals and ensure that they pay the same tax as domestic producers. Second principle is coordination. If countries can coordinate their tax rates, they should do so. For example, if the group of 20 countries agreed to impose a minimum corporate tax rate of 25%, suddenly then more than 90% of the profits around the world would be taxed at 25% or more. So that would clearly reduce the incentive for corporations to try to shift between different countries. A common objection is, well, if you were to do so, wouldn't you simply have multinationals changing their nationality from Germany to Bermuda or wherever they can get the lowest corporate tax rates, which a process called a tax inversion? Well, the evidence on the matter is simply that it's extremely hard to do so, to prove your new nationality. Mostly it means that multinationals must merge with a sufficiently large foreign firm in the country where they want to declare their new nationality. And even then, there are further conditions that must be met. So it's much harder than the idea suggests. But definitely, it is a threat that that government should take into account and try to make even more difficult to achieve this sort of tax inversion. Okay, the third pillar is on defensive measures. Well, what to do about those rogue tax havens that refuse to coordinate and take part in these sorts of tax alliances? Well, let's consider an example. Suppose Switzerland refuses to tax Nestle at the global minimum of 25% for whatever reason. They think it's in their own interest, or for whatever reason they may want to give. Well, what can those coordinating countries do? They can collect the tax that Switzerland refuses to collect. How can they do that? How can they achieve this? Is well, by an apportionment mechanism. What does that mean? Well, it means that you try to estimate how much, what percentage of Nestle sales are made in each country. And once you know the percentage of sales made in each country, then you tax Nestle on that percentage of sales. Now, it may seem like it's a bit of a fantasy, but in fact, this is already in existence. This sort of mechanism is already in existence in various parts of the world, in the US most notably, between the various states. That's how they dish out corporation tax between the states, is by simply looking at how much a corporation makes in sales, and then say, well, that money was made in my state, therefore I have the right to tax the profits resulting from that percentage of sales. This is the simplest version of such an apportionment mechanism. There are more complex ones, but we'll leave it there, I guess. Okay, and lastly is the idea that you can, you will always have countries that are trying to change the way they impose taxes. This is called regulatory dialectic, right? That changes in regulations are always met with changes in action, perhaps by those rogue tax havens, which makes the new regulation less effective or ineffective. So if you have tax havens that simply are always trying to change their laws to try to get around those coordinating countries, well, then you still have, let's say, weapons in your arsenal. For example, you can impose sanctions in the form of taxes on capital flowing out of that tax haven, or imports from those tax havens. And we have an example of this kind of sanction, which is the FATCA example that we gave, I think, in last week's lecture, where the US imposed sanctions on countries that would not share information on the accounts, bank accounts and assets of US citizens living abroad. And it seems that, although flawed, it has had some success in ensuring that countries cooperate on sharing these sorts of details. So in that case, you can impose sanctions on the tax havens that do not collaborate, do not cooperate, and therefore pressure them into cooperating. Okay. So to sum up, what have we learned today? Well, firstly, profit shifting is a massive problem because it reduces the tax revenues in most economies for a relatively small tax revenue boost in tax havens. It's a zero-sum game where few win. More than that, it's very unlikely that if other countries try to copy this tax haven model, they will simply fail to do so successfully. Tax competition, on the other hand, can boost real investment in jobs, but is extremely unlikely to do so in the vast majority of countries. The economic reasoning for joining the race to the bottom, especially in larger countries, is highly questionable. And lastly, what to do about it? Well, the necessary changes are in the form of remedial taxes and abandoning this outdated arm's length principle for some kind of apportionment mechanism. If we want to go even further, then we should consider much stronger international cooperation and even sanctions against those tax havens that refuse to comply. Okay, I hope you have found it interesting. It's a little bit of a complex topic at points, but is a very relevant one, and the trend is extremely clear. And it's very hard to sugarcoat the trend and say, well, no, this doesn't matter. This is all for the better. It's almost certainly it's one of the defining trends of our time. But at the same time, there is some good innovation from the policy side, which we can see as sort of strong and radical enough to actually address the problem at hand. Okay, that's it for now. Thank you very much for your attention. I look forward to discussing these sorts of topics, or this topic with you on Thursday. Okay, bye for now.